Let's go ahead and talk about the consolidation of mid-year acquisitions. Now, most acquisitions of a subsidiary, actually probably all of them, don't occur on January 1st as we've assumed up until now. We've made that simplifying assumption in all of the cases up until now, but it really is unrealistic. So what do we do when a subsidiary is acquired at some date other than the beginning of the year? Recall that under the equity method, the parent reports their share of the investee's post-acquisition earnings and post-acquisition dividends. The parent has no claim on the earnings earned prior to their acquisition of the investee. The same concept applies in a consolidation. When the consolidated income statement is prepared, the consolidated entity has a claim on all of the parent's income for the full year, plus the parent's share of the subsidiary's post-acquisition earnings. They have no claim on the subsidiary's pre-acquisition income. Now, how can we accomplish all this? Before going any further, it's reassuring to realize that all of this mid-year acquisition stuff only affects the year of acquisition consolidation. Subsequent years are handled just as they've always been handled. So let's go ahead and run through an example. Let's assume that Big Company acquires 60% of Little Company on December 1st, 2016 at a cost of $48,000. The fair value of the non-controlling interest on that date is $32,000. And let's assume that all assets and liabilities have fair values equal to book values, so any differential is attributable to goodwill. And let's assume that Little has the following trial balance on the date of acquisition. They've got assets of $120,000, liabilities of $70,000, equity of $30,000, and since they're in the middle of the year, they're going to have some open revenue and expense and dividend accounts. They've got revenues to date of $50,000, expenses to date of $20,000, and dividends to date of $10,000. And we note that this trial balance debits equals credits, as of course it should. When we do our cost versus book value differential analysis, we need to be careful with how we compute book value. Up until now, as a shortcut, it's been possible simply to look at the equity accounts. Again, if we make our acquisition on January 1st, there are no revenue, expense, or dividend accounts open, so assets equals liabilities plus equity, or assets minus liabilities equals equity, net assets, book value, owner's equity, all equal. In this case, though, net assets are $120,000 minus $70,000, or $50,000, which is not the same thing as owner's equity. And again, the reason for that is that we have these revenue, expense, and dividend accounts open. So we need to do one of two things. First, we can compute book value as assets minus liabilities. And that's very easy in this case, since there's one big asset value and one big liability value. Or in a method which might be useful for other reasons, we can perform a sort of pro forma closing analysis. In other words, if we were to go through a closing on December 1st, 2016, closing revenues, expenses, and dividends to retain earnings, what would be the resultant total equity figure? Now, Little has earnings as of the date of acquisition of $30,000. Again, that's revenues of $50,000 less expenses of $20,000. And they have dividends as of the date of acquisition of $10,000. So if we were going to do a pro forma closing, we would take the existing equity balance of $30,000, add their $30,000 of income as of the date of acquisition, and subtract their $10,000 in dividends as of the date of acquisition, giving us a revised or updated equity total of $50,000, which is again assets minus liabilities. So let's go ahead and go through our differential analysis. Again, the cost of our 60% was $48,000. The total value was $80,000. Again, that's our cost of $48 plus the non-controlling interest of $32. The book value is $50,000. Again, that's the revised book value based on either assets minus liabilities or the results of this pro forma closing we just did. Our share of that is $30,000. For a differential, which is all goodwill, $30,000 total, $18,000 for our share. Now let's assume that the final end-of-year revenues and expenses are $65,000 and $25,000 respectively, for a total income of $40,000, while total dividends are $15,000. So if total earnings are $40,000 while pre-acquisition earnings were $30,000, that means that the post-acquisition earnings were $10,000. Similarly, if total dividends are $15,000 while the pre-acquisition dividends were $10,000, that means there was $5,000 of additional dividends post-acquisition. Now first, just to refresh our memories, let's go ahead and do our equity method entries for this first partial year of ownership. Again, there was $10,000 of post-acquisition earnings. Big owns 60% of Little, so they own 60% or $6,000 of those post-acquisition earnings. And similarly for the dividends, there's $5,000 of post-acquisition dividends. Big will receive 60% of that, or $3,000. Now, let's go on to the consolidation process then. How do we deal with this partial first year's consolidation? Recall that the date of acquisition equity accounts plus or minus the existing revenue, expense, and dividends accounts is the date of acquisition book value. Now recall that in our elimination entries, that initial S elimination entry, we eliminate the subsidiary's beginning of period owner's equity or book value. So to do that, in this case, we're going to eliminate the beginning of period subsidiary equity accounts, plus we're also going to eliminate the date of acquisition revenues, expenses, and dividends. So this first S entry, we're going to eliminate the subsidiary's beginning of year equity balance. We're going to eliminate their date of acquisition revenues, their date of acquisition expenses, and their date of acquisition dividends, and record that goodwill. So here, basically we're adding the elimination of the date of acquisition revenues, expenses, and dividends, and that total is split between the parent's investment in Little and the non-controlling interest. Now again, what this does is remove the pre-acquisition revenues, expenses, and dividends from the consolidated financial statements. The problem with this is that the resulting consolidated revenues or expenses or income or dividends don't reflect a meaningful number. In this case, the consolidated revenues amount is going to include Big's revenues for the full 12 months plus Little's revenues only for the month of December. We are eliminating Little's revenues for January through November. Same thing with the expenses. The consolidated expenses will include Big's expenses for the entire year plus Little's expenses only for 1 month. So the resulting total consolidated revenues and expenses, and therefore income, are not useful for projecting or estimating or extrapolating future revenues, expenses, and income. Now, I just pulled some numbers out of thin air for this partial worksheet. The only requirement was that Little's revenues less expenses had to equal $40,000, and that Big's investment income is that $6,000 that we recorded under the equity method. And there's our elimination entry just to remind us. So let's go ahead and post this to the portion of the worksheet that's shown there. We're going to go ahead and again, we're eliminating Little's revenues for the first 11 months of the year. We're eliminating Little's expenses for the first 11 months of the year, and we're eliminating Little's dividends for the first 11 months of the year. So the resulting totals, let's look at revenues for a moment. Revenues, Big $100,000. Of Little's $65,000 in revenues, we're eliminating $50,000, so the consolidated revenues are $115,000. Now, if we expect, say, 10% sales growth next year, this $115,000 of consolidated revenues is useless for purposes of projecting into the future. Now, our financial statement readers, they don't see the worksheet. They just see the consolidated column. They just see the total column. So if a financial analyst is trying to project, what would be the result of a 10% revenue increase, he'd say, well, 115,000 plus 10%, 11,500, is 126,500. Whereas in reality, Big and Little for the full year had 165,000 of revenues. Big had 100,000, Little had 65,000. Projecting that at a 10% growth, it would be 165,000 plus 16,500, or total combined revenues next year of $181,500. So again, these consolidated totals for revenues, expenses, and therefore income really are only marginally useful, if that, for projecting into the future. Again, just reading off what I've got written there, the problem is that the consolidated revenue number of 115,000 doesn't represent a full year's worth of revenue for the combined entity. It's a full year for Big plus 1 month for Little. So again, those numbers aren't useful for extrapolation. Finally, I want to note that Little's dividends are being eliminated in 2 steps. We eliminate the pre-acquisition dividends in the S entry. So there's that $10,000 credit to the dividends row with the S next to it. The $5,000 of post-acquisition dividends, those will be eliminated in the D entry. So Little's entire dividends are being eliminated, but it's being eliminated in 2 steps.